equity, mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
All right, well, welcome back to another episode of Equity Mates, a podcast that follows our journey of investing. And whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. Now, while we are licensed, we're not aware of your financial circumstances, so all information on this show is for education and entertainment purposes only, and any advice is general. And if you're just getting up to speed and you're just starting your investing journey, then we do have a podcast called Get Started Investing that might help you get up to speed with the basics. But with that said, my name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. A big episode today. We're going to be talking about the big announcement from Apple last week, the Vision Pro, and what that might mean for investors. We're going to be picking up the conversation around your mentored conversation and some of the actions that you've been working on. And we're going to be speaking to a member of the Equity Mates community. But first of all, we need to just take a quick minute and talk about FinFest.
Yes, we do have an update. And Ren, regrettably, we've decided to postpone FinFest until 2024. Last year, we put in a huge amount of effort to launch FinFest, and we couldn't have achieved it without, firstly, your support, the Equity Mates community, but also the backing of a lot of our major partners. And the current economic climate and cost of living crisis has seen many businesses reduce their marketing budgets, and as a result, it's become impossible to deliver FinFest 2023 at the scale and quality that we really want. So we did explore the option of hosting a smaller event. We did explore the option of increasing ticket prices, but it became clear that it wouldn't live up to the standards that we set for ourselves for FinFest last year.
Yeah, now there is good news. We do have a date for 2024, 26th of October. Mark it in the calendars. We're really excited to bring another FinFest, and I guess fingers crossed, touch wood, that their marketing budgets in the finance sector are back where they were. But yeah, for now, for this year, for this moment, we can't throw it.
Yeah, we don't want to compromise the experience that we created for you guys last year. And as the saying goes, we are only as good as our last event. And we want to make sure that the next one surpasses all expectations. So we're pausing 2024. It'll be back October 26th. There is still a link, equitymates.com/FinFest, where you can leave your details and keep up to date with tickets and information as it comes. But despite the postponement, we still do want to offer in-person events during this year because so many of you have put your name down. So we're going to ensure that later on in this year, we get around to some of the cities in Australia to connect with you guys and do some cool stuff as well. So stay tuned for that. We do apologize if it's caused any inconvenience for any of you, but we do thank you for your support as always and look forward to seeing you either later this year or at FinFest next year.
That's it. All right, Bryce, well, let's get into it and let's start with the news of the moment. And that is we have potentially seen the next step forward in computing, or a massive white elephant, and that is Apple's new Vision Pro.
What did you think?
I was pretty impressed. But Apple always have a really slick launch, and then the first users, because the first user tests and reviews have been very positive, but Apple are giving it to big fans of their products and tech people who are early adopters. So I'm excited to try it, I think, is my big takeaway now.
Same. I would love to try it. They do an epic job at making things look cool. I think when Apple do ever release anything, it is of such quality. Your comment at the top, is it the future or is it a white elephant? That's, for me, the unknown, I think, in its current state.
Well, I mean, you came in hot to the office the day after. You said it was the future straight away.
It is.
You were like, I'll write a check right now if I could get one.
I think in 10 years, so apparently you can see the evolution of this being something along the lines of, in its current state, it looks like ski goggles and it's got a cord going to a battery that sits in your back pocket and it lasts like 2 hours or something like that. You can obviously see a progression where technology becomes better and the ability for it to project at higher quality and across smaller lens with better battery life, et cetera, over time, you're getting to the point where you're literally wearing what would be a normal pair of glasses, and it doesn't look anywhere near as obtrusive and nerdy and unsocial. And at that point, we'll look back on this moment and probably be like, wow, that was the iPhone of 2008. Look how far we've come.
Yeah. So it's probably important to just set the context that we have seen this before from other big tech players, and Google was the first. 2013, they launched the Google Glass, which is exactly what you're talking about. The smaller glasses.
Yeah, but I don't think the technology, from what I've read and listened to, the technology isn't there to deliver what Apple have put into theirs, which is communication via your eyes and hands. You're controlling your glasses. And what you're seeing and visualizing is not there to get it into the glasses like I'm wearing right now.
Yeah. So Google 2013 launched the Google Glass. People hate it. Like, people criticize it. The term glass holes gets termed for people who are wearing Google glasses, privacy concerns because people are out in public with the cameras filming and all of that stuff. By January 2015, launched in 2013, by January 2015, Google pull it off the market. They try and relaunch it, I think, a few years later as a B2B product, and this year they've pulled it altogether. So Google Glass, failure. Microsoft come along 2016 with the Microsoft HoloLens, and they pitch it more as a B2B product, and it feels like it's got a little bit of traction but not a heap. They had a massive order for the US military. The US military bought about 100,000 of them. There's like some surgical applications where if you're a doctor or you're a surgeon, you put the glasses on and it'll like show you where to cut.
That's interesting.
I hope my surgeons know without the glasses. The best application I've heard of the Microsoft HoloLens is in warehouses. So, like when you were working at Woolies and you went to a distribution center, people had the headsets on and they were told, like, go to this bay, collect this, that kind of stuff.
Yeah.
With the HoloLens, rather than getting told in your ear, it like the box that you got to pick will like light up in front of you with the augmented reality.
Yeah.
That's pretty cool.
That is.
But Microsoft haven't had a heap of traction. Then comes along Meta, Facebook. They buy Oculus, and then Meta launched the Quest 2019.
Meta Quest.
The big difference between what Apple have got and what Meta have got is that Meta is just virtual reality. You can't see through the glasses. Apple is augmented reality. You can see through the glasses. Meta are trying to sell their product. It's about 10 times cheaper than the Apple glasses, but they haven't really hit. So that's the context.
If you look at some videos online of people who have got the Vision Pro from Apple and the Meta Quest, and they're comparing the two, worlds apart in terms of quality.
Yeah,
worlds apart.
That doesn't surprise me.
Worlds apart. The point was raised that, when Meta went hard on Quest and Google and co, and did Apple go, we're going to need to be in the game here. Let's sign off on development of our own glasses. Would Tim Cook, after the failure in inverted commas of all three of these, would Tim Cook be signing off now on the glasses, knowing what he knows?
Or, alternative theory, Apple and Facebook have been explicitly criticizing each other. Apple for Facebook's breach of privacy and data protection. Facebook because Apple basically really damaged their business model when they put some of their privacy stuff in. Like, they've been pretty explicitly warring. Is this a spite project from Tim Cook?
Well, that's, I think, what the suggestion was. Let's just do something to make sure we're in the game.
Yeah.
And they've done it and it's better. But like from an investor point of view, a shareholder of Apple, and from like a meaningful revenue generating idea, I think the maths are that they're projecting to sell 150,000 units of this thing, which is going to be about $500 million bucks.
Those projections just aren't worth the paper they're written on at this point.
Apple are projecting that.
Yeah, but like, what were they projecting for the iPhone back in the day? It's like...
Well, no, this is first year.
Yeah.
This year they're saying at the unit price, based on what we know, we're expecting to sell 150,000. So it's 500 million in revenue. They made almost 400 billion. So it's a tiny speck in the grand scheme of things.
It is the biggest product that Tim Cook has launched. I think outside of this, it was AirPods and Apple Watch.
I'm loving the rumours that Apple is on track to be one of the first companies to hit $1 trillion in revenue. But to do that, it's like, what do they need to do? And my friend, my mate, Scott Galloway, he is really bullish on Apple coming out with the car. He reckons that's how they get to $1 trillion in revenue, an Apple car.
Yeah.
Hook up with some...
Tesla.
Well, yeah, or you hook up with some car manufacturer who has the capacity.
Yeah.
Make it beautiful.
There's an argument, though, that they have... With the car play, they've decided we don't need the car. The value is in owning the car's tech ecosystem and being like the point of sale and the app store for the car and stuff like that. And the car plays in like, I think over 200 million cars or something stupid these days. You know who must be peaking? Snap. Snap.
Because they were original, yeah.
They pitched themselves in as an augmented reality play, and they've tried the glasses a couple of times, and they're just going to get blown out of the water by these big companies and their big budgets.
Yeah, I remember we were at uni and they brought out the Ray-Bans with the little lens in it.
When they IPO'd, they were like, we're not a messaging app, we're a hardware company.
But it's good that they've realised where their talents and core customers lie, and it's not in VR, it's in instant messaging.
Yeah. What we saw in the product launch was people wearing the glasses and then creating screens in the glasses. And it's just a reminder that when we launch new technology, we really anchor to old technology. And so it's like we put these glasses on where we don't need things to be in a screen. Like, we use screens because they're the best way for us to see content, like whatever's on our computer. But with these glasses, like, it could be immersive. You know, Alf was talking about how you could wear them while playing golf and you could have like you could tell it to project 10,000 people in the crowd watching you and cheering you on as you hit your part. But instead it's like, we just create TV screens or computer screens through the glasses.
That makes sense. For now.
Yeah, well, the thing is, like, that's not how these will be used.
Yeah, but again, like, it's the first iteration. In 10 years, the golf will be there. Imagine going cycling, you'll have them on. It'll give you all your stats. It'll show you how to take corners, driving. Like, it'll all be there.
Yeah. Well, and it's just like, rather than like watching, you know, they showed us like, oh, you'll watch the sport and you'll create a screen in front of you and you can make the screen whatever size you want. But it'll be like, no, you're sitting in the game.
Yeah, you would think in future. But for now, like, I don't think you couldn't do that, because the way that
no, but get us excited about it.
The way it's all fed in. I like the idea of it. We'll never need a computer. It'll just be like, I throw my glasses on, I can have a screen, I can have Excel anywhere.
You know who would be shaking in their boots is screen makers. Yeah. Like TV makers, computer monitor
they might
makers.
be putting themselves out.
Apple don't make TVs.
They make screens.
That would be a third-party manufacturer that
they make computers.
They do make computers. You're not wrong. And
they
phones.
literally make computers.
It just reminded me of the early days of the internet, where it was like, now you can have a newspaper on a computer, and then it's like, oh no, the use cases of this were just unimaginable at that time.
Yeah,
and I think that's the same here. Yeah. If it hits,
it'll hit. I'm very bullish. If you're bullish, let us know.
Do you own Apple?
Yeah. Well, I own it through Fang.
Yeah. I'm the same. I don't own it directly.
So if you're bullish or bearish, come and join us in the community, the Facebook discussion group, to keep the conversation going. Would love to hear your thoughts. If you're a shareholder, what do you think it means? If you're not, does this change your mind? So come and join us in the Equity Mates Facebook discussion group. But Ren, we're going to take a quick break, and on the other side, we're going to pick up my mentored progression with Henry. I had some work to do, so let's crack in straight after this. So, Ren, we are on our journey with our mentors, our coaches. If you've just joined us for the first time, Ren and I have each paired up with an expert investor. Ren's with Andrew Page. I'm with Henry Jennings from Marcus Today. And throughout this year, we're sitting down with them to discuss and try and become better investors and find new ways of building an investing universe and making some investments. Now, last week, Ren, we spoke about a strategy with Henry around finding what is called the dog kennels.
That's right. Yeah.
The stocks that have been slammed over the last 12 months and potentially have a catalyst to come in 2024 or in the next financial year, more specifically, as people sell their stocks going into the end of financial year to capture the capital gains.
Oh, no, so to capture the capital losses.
Capture capital losses, yeah. So I actually gave Henry a buzz yesterday just to touch base with him. He's a very catalyst-driven guy. I didn't actually record it. It was a great convo as well. I'm kind of kicking myself.
I feel
it
like
was one of those ones where
I feel like that was the explicit rule when we start this. Record everything.
It wasn't intended to be a conversation about this, but it turned into one. And are you
doing social catch-ups with your mentor?
Yeah, just how's it going? And halfway through, I'm like, damn it, I should be recording this because it would have just been so much better. But overnight, the Fed have paused interest rates, and we're in a bull market all of a sudden. Since the lows of October, over in the US particularly, the Nasdaq and the S&P are up over 20%.
Nasdaq is up more than 30% year to date. Yeah.
So technically, that means we're from bottom to 20%. You classify yourself as in a bull market, so we're in a bull market, which is just crazy. And so for Henry, this is a catalyst for him. He's just thinking where, everyone keeps talking of recession, but unemployment in America is still incredibly low. Inflation, he now thinks, is a rounding error at 4%. And so the only thing, and he feels like there's a lot of FOMO now and greed starting to come back into the market. So how far that can go, who knows? But it is interesting, since we last spoke, we were talking about the AI bubble, and a lot of those stocks have come off. Appen, we were talking about, is down 25% within the space of a couple of weeks from its high. So luckily I didn't get on that trade. I just sat that out. But I pulled a list of worst performing stocks, Ren, and what I did was pulled every company in Australia that has fallen in the last 12 months. There's 1,409 of them. So then I added stocks that are down in the last month. So that brought it down to 1,008. And then I added a market cap of 100 million or more, because you want a bit of liquidity. So that gave 288. And some interesting stocks in there. Zip, obviously, is a big one that has been absolutely smashed. So what I've tried to do here is just pull a list, and now I'm going to watch this list over the next 2 to 3 weeks. If increased selling continues, and then have a chat with Henry about where do we think there's opportunity for a catalyst. Because it's interesting, as some of them, we'll get to some. But anyway, Zip down 67%. There's a lot of retail in there. Beacon Lighting down 29, Baby Bunting down 69, Nick Scali, Adairs all getting hammered. The ASX down 22%. Now, I called Henry about this. Did you know SIBO, which is the competing exchange here, now has 20% market share?
There you go.
Yeah. And
but
so,
in commodities, or in like options and futures, or
I don't know,
because they don't have a lot of direct equities. I mean, they have
they've got
that tracking thing.
Yeah,
but who's buying the tracking?
What are they called? DRSs? Oh no.
Aren't they
ADRs or whatever it is?
No, that's like when a Chinese stock is listed in the US through an alternate deposit receipt or whatever it's called.
Yeah, doesn't SIBO do that?
Maybe. I thought they just did. They just tracked the ASX listed stocks somehow.
Right. Well, he was saying a lot of the industry, the fundies, really like the SIBO guys.
Right.
And the ASX is really battling with the reputation they had with chess.
Yeah.
And the whole stuff up there.
Yeah.
So it's down 22%, but he said it's in the dog kennel. Don't go near it.
I mean, like some of the companies you said there, like Nick Scali has been a great company for a long time.
Yeah.
Not a industry that gets me super excited, the furniture industry. But like you're picking a lot of companies that are just like not great.
Yeah. Well, this is the point. They're in the dog kennel. And I think
it's such an uninspiring way to invest.
I know. I don't think I'll make any investments from this. I think I was clear with that last week. I'm just interested to see how the strategy plays out. Yeah, like for me, it's like Zip, for example, down 67%. They just did a capital raise. I think their stock is at about
70 cents or something?
No, it's a bit lower than that, 49 cents. They just did a capital raise themselves at 47 cents. So like That gives you an idea of where they think their valuation is.
No, that's not where they think their valuation is. That's where the market is willing to.
Well, that's what I mean. Like,
Yeah, okay. Yeah.
Also, interestingly, they abandoned the Sezzle deal. Remember that?
Yeah, I do remember that.
Since then, Sezzle has actually performed better than Zip.
There you go.
Yeah. I think Sezzle is actually up something like 1,000% in the last year or something off the back of that. Something crazy. Anyway, Calix is one that we have spoken with Henry about before, and was one of those stocks about a year ago that everyone was speaking about. It's down 35%, but nothing has changed a lot there. There's just no new news. Macquarie down. Bailador, Ren, down 22%.
Oh, yeah.
Great opportunity here. Called Henry about this as well. He thinks this is quite an interesting one. Heaps of cash on the balance sheet. Questioning whether it's a good opportunity for them to do a buyback. But just like we know after speaking with Paul, obviously their biggest holding is SiteMinder. InstaScripts is up for sale. They haven't exited it yet, but that could be a really good boost if it does happen. And obviously trading at a massive discount at the moment, which is how they run things.
I'm a Bailador
You're
shareholder.
a Bailador shareholder, yeah. So there are a couple of names. I'm just going to keep an eye on them.
Can I just go back to Sezzle? You said it's up 1,000%. It did a stock consolidation, a reverse split,
go.
38 for 1.
There you go, 38 for
Come
1.
on, bro.
There you go.
Let's not. So, and what that means is that for people who owned shares when Sezzle was in like the 20-cent range, Sezzle took, for every 38 shares you had, they just gave you 1, and now it's in like the $25 range. Yeah.
Yeah, Zip's an interesting one. We actually went and spoke with Larry Diamond, CEO, while we were in the States. He's obviously very bullish. He's a great guy to chat to, but yeah.
Like, that's the thing with some of these guys. Like, they built incredible businesses, but the market got so ahead of its skis that now everyone is like, it's terrible because they've come off so much.
Yeah.
But it's like, if you just hadn't had the bull market of 2020 and 2021, you'd be like, it's an Aussie payments company expanding to the US.
Yeah.
But like share prices has such a signaling mechanism, and you've got to keep up with the hype.
Yeah.
Yeah.
So there's the list I'm going to keep an eye on. I just want to close out with 2 pieces of audio from our conversation last time. This is purely for the lithium lovers out there on what Henry hopes is going to be a 10-bagger.
And then you look at a company, I've been looking at a thing called Latin Resources, which is another lithium hopeful. LRS is the stock code there, which is in Brazil with a project called Salinas. And we've talked about catalysts before, and I saw these guys present at a resource conference, and a very sharply dressed, mild-mannered CFO got up and made the presentation. He'd only been with the company a couple of months. He'd lived in Brazil for 3 years, so he obviously spoke Portuguese. Very mild-mannered, very softly spoken, very confident, and he knew his stuff. He knew it inside out, backwards, and not the geology, but the funding, the finance, the potential, and he knew which buttons to push. And at the time, we were talking about Latin at 8 or 9 cents, a while ago, 6 months ago, say, and I looked at it at 13 cents and said, this is going to pop, and it did. It went to 18, and it stuck there, so that's good. It's easy in some respects because he was talking catalysts and timelines. Every time something happens with a miner, and we've talked about this before, whether it's funding, pre-feasibility, definitive, or final investment decision, every step along the journey as a business, if it ticks the box, then it should be re-rated. So for Latin, their next door neighbour is a company called Sigma, which had a 13 million tonne lithium deposit, and they now got a 105 million tonne lithium deposit. It's taken them 4 years to prove it up to that size. But in that 4 years, the company's gone from worth tens of or hundreds of millions to billions. And you can see the journey with Latin, which is due an upgrade in June. You can see that journey, that timeline, because they want to go from 13 to 100.
Yeah.
And if they do, then the valuation will follow.
Yeah. So
it'll turn into a 10-bagger from where it is at the moment. I mean, it's got to tick all the boxes, and it's got to find 100 million tonnes and prove it up. But that, in theory, is the catalyst that you'll see along that journey.
So Henry is deep in the lithium scene, knows a lot about it. At the time of recording, 15th of June, the re-rating hasn't come, but it is coming this month. So if you're a lithium fan out there, don't take this as investment advice, but there's just a little bit of insight from Henry. I did talk to him about it yesterday. He's super bullish, currently trading at 20 cents.
Yeah.
This is not investment advice.
No. Certainly one to add to the watch list if you are interested in the lithium space.
Yes. Now, Ren, just to close out.
So just to summarize where you and Henry are at, it's basically like, what are the worst companies and where are the mining speckies?
The dog kennels and the mining speckies. Yes. Yeah. Well, as I said at the top, I think last week, and I said 80% of my investing strategy here is not changing. It's the core. I have made a couple of other investments outside though recently.
What did you buy?
More Macquarie. I can love Macquarie.
Not investment advice?
Not investment advice. I've done one from a stock tip that we've got here from the Equity Mates community.
I don't think you can say that. That's way too small.
I'm not going to say what it is, but I'm in it, as are some of the other guys. It's a resources company. I've also gone long on ATEC, the Australian Technology ETF that I have ticking away, put a bit more in that, and also a bit more in FANG Plus, which is just a more concentrated technology ETF.
Nice.
So ticking away at both of those. Not investment advice, of course. So, Ren, to close out here, we've just come back from Berkshire, and Warren Buffett's number one rule is don't lose money, and his second rule...
invest in dogs and specky stocks.
And his second rule is don't forget rule number one.
Yeah.
And so I just asked Henry what his thoughts on that were, and how, at our age, should we or could we be thinking about capital preservation? Because my current investment strategy is long equities, ultra long, and I don't have a capital preservation strategy, so to speak. Like I'm not, I don't have a huge defensive part to my portfolio, and I'm definitely not selling in and out. Like if I see a moment in time where I've got profit, I'm not trying to capture that.
But neither's Warren. Like that's not what he means.
That's exactly what Henry said.
Oh, okay. Yeah. Well, let's get
so let's just close it out with Henry's thoughts on how we should be thinking about markets and capital preservation at our age.
I think you're thinking about it exactly right. You've got a long road in front of you. You're only a young guy. Even if the worst happens and the market drops 25, 30%, you've still got years in front of you to recoup that. Not everything will drop. Buffett may have his rule about not losing money, rule number one and rule number two, but he also talks about buying a business. It doesn't matter if the stock market closes for 5 years. So he's looking through that short-term volatility. So rule number one and rule number two kind of as hard if the stock market closes for 5 years and the business is just still the business. There's a bit sort of contradictory there. I think at your age, and I think people starting out on their investment journey, time is on their side, as the Stones rightly pointed out. You can afford blips. And when you look back, even, the biggest blip I saw, apart from the GFC, which was a pretty big blip, was the 87 crash. It was for me, that was I was 25 when the 87 crash came up. And, luckily I was relatively impoverished at the time, so I didn't actually have a lot of money in the market. But when you look on the big scale of things, the 87 crash is a tiny weeny little thing. We may look back in 5 years' time and go, the NVIDIA frenzy was just the biggest thing to hit the market since the GFC, but in the other way. So time is on your side. I think, if you want to do capital preservation, there are ways to do it short term, but ultimately, you're looking at the long term. You're looking at building wealth over 20, 30, 40 years rather than retiring in 3 years' time.
Yeah.
You can afford dollar cost averaging or whatever you want to call it, averaging down or just putting in that money over a long period of time, every month or every week or whenever you've got it, it works. Why try and protect your capital when you're still in your 20s?
I'm 32.
Oh, yeah? Baby face. All right, well, okay, let's change that. I would protect your capital at all costs because you haven't got that long in front of you.
True.
But your time should be concentrated on your business, paying down your debts if you've got them, student whatever, or mortgages if you can get one. Not that anybody can these days, apparently.
Well, I'm currently in the midst of trying to get one.
Oh, yeah?
And I don't know if it's hellish out there.
Yes.
It's hellish. Well, there you go, Ren. As you said, buy dog kennels and specky socks.
So I actually had a chat with Andrew, my mentor, this week, and just as a tease for an upcoming episode, we're taking a different path to Bryce, and we did some work on valuation. He gave us a valuation methodology last time we chatted, and I actually went away and did some work and tried to do some back of the envelope valuations. I did it for a couple of companies. We only spoke about one on the podcast. We might publish it on our website, the others, but that's coming up in a future episode.
Awesome. Love it. We'll stick around because next episode, we're also bringing in Julian McCormack to get his views on where the market goes from here as we are now entering a bull market. So, Ren, we'll leave it there. We'll pick it up next week.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.